Now we're going to jump into the URS portfolio itself and take you through our KPIs. And we switched up the format here a little bit to be a little more portfolio driven and then highlight some of the assets as well. So it's going to be portfolio level stats. So we have 14 assets in our portfolio that make up a little over 2,700 units across 5 states. As Chris touched on earlier, right? North Carolina, South Carolina, Tennessee, Georgia, and Maine, Portland, Maine. So you can see the layout of our portfolio there. So the first thing we're going to touch on is Q3 traffic and occupancy. So again, I touched on earlier, we have stabilized, we have recently acquired, and then we have our developments and lease ups down below. So on the stabilized assets, that's 1,673 units. Across 6 markets, we had just about 3,800 leads. That's all sources of leads, right? Online, offline, etc. That translated into 604 tours and 253 net leases for the quarter across the stabilized assets. So we closed out the stabilized portfolio at 96.1% occupancy versus 95.5% occupancy at the close of Q2. Our recently acquired assets is 600 units across 3 properties. We had 2,000 leads, 338 tours, and 125 net leases with occupancy at 93.3%. And that's a huge improvement from 84.5% the prior quarter. So these are deals that were either distressed or in some major reposition, or we bought knowing that there was going to be a purge before we start to come back online. Our development, the Ash, which is in lease up, and Cypress, which is not opening up till the end of Q1 2025. So basically, the Ash went from 4.6 to 14.6. They had 54 net leases for the quarter, which is pretty fantastic across 3 months, just shy of 20 units a month, which is a fantastic goal to achieve in this environment. So really happy about that. And then this shows you a lot going on here for you to see, but it's the breakout on a per asset basis, quarter over quarter, with blue being the current quarter, Q3, and gray being Q2. So you can really kind of see, which assets from an occupancy perspective, moved quarter over quarter. One of the biggest movers here is obviously flats at Leland. We closed Q2 at 66%. And we closed out Q3 at 93.7. And that was one of the distressed deals we bought. So when we bought it, we were about 23% occupied. Fast forward, it had a bunch of down units. Property was a mess. No staff had been there, nothing. We invested capital, brought the resources in, built a great team. And our team there, led by Allison, did a hell of a job. Took the property from 23% to now 99% leased in 1 year of takeover. So that was one of our biggest movers quarter over quarter. The rest pretty much stayed pretty tight. We had some really good movement. Creekside at Asheville, which is part of our little 3-pack that we own there. And the Ash was one of our other biggest movers, obviously, quarter over quarter. So Q3 move-ins and renewals for the quarter, we had on the stabilized portfolio 340 move-ins, which is up about 50 versus the prior quarter. Average increase on move-ins was only negative 0.2%. And number of renewals was 184 renewals. The average increase on renewals was 2%. On our recently acquired assets, we had 146 move-ins and versus 69 the prior quarter. And those average trade-outs on new leases were negative 2.3%. However, we had 97 renewals on the existing asset, on the recently acquired assets, and that was 3.6% increase on those renewals for a weighted average of about 2.4% quarter over quarter rent growth. So I think it's interesting to understand the dynamics. We are focusing on occupancy over rents. I touched on that last quarter. We made some significant investments in technology earlier this year that's really taken the emotion out of how we think about our operations and making us more NOI focused versus top line rent focused. right? So we're able to peel back concessions, find the right rental rates to achieve the occupancy goals that we need and want at our assets. And you'll see shortly, it's translating to NOI growth quarter over quarter. So again, a lot of this is, we're seeing headlines, hearing reports. We're at the tail end, as Chris touched on earlier. We saw that 50-year dump of supply come to us, over the last 3 years in a very short period of time. That does not get absorbed overnight. If you look back at our, year-end report, I put some of those comments in the last quarterly update. And it really, I'm extremely proud of it that, we were very transparent and open with our investors the end of last year when a lot of the public REITs and some of the bigger shops and the brokerage shops are, everything was survived till 25, supply is going to be done and rent growth is going to be back. We felt that supply was not really peaking within our markets until Q4, Q1, Q2 of 2025. And then that product has to be absorbed, right? That's going to take another 12, 18, possibly 24 months to get there. But we're starting to see pockets where it's normalizing. And when you start to look forward, as Chris referenced earlier, new starts are down dramatically, relative to historical levels. I just listened to a podcast, for those of you that know Norm Radow, Radco. He's been in the business for, 30 plus years. He's probably one of the most well-respected investor, owner operators in the multifamily space, and specifically in the private capital space. He made a reference that, different data providers that he's talking to, the big research firms, are expecting to potentially see completions at the lowest level since 2012 when you start to look out to 2028 and 29, or 27, 28. That's what we're trying to position ourselves well for. It's buy good assets again, good locations with a value add or some sort of opportunistic strategy that we can go in and leverage our operating platform to have these assets cash flowing. And then we have a free call option on, when to sell in the future. But we can get these properties, with a target, cash yields of 6 to 8% plus inside of the first, 24 months, and then have the ability to incrementally grow that over time and sell opportunistically into the future. So hope that was somewhat helpful for those of you that are, reading the journal and, other online platforms that are talking about how, rents are down materially. This is real live data that comes extracted directly from our portfolio. And then you could see here, this is really just the move-in activity for each asset. Cobalt Row, I'll highlight. This is an anomaly. It's student housing. So all the leases expire July 31st, and all the move-ins happen from, I think the lease expired July 26th, and the move-ins happen pretty much between August 1st to the 17th, which is why there's such a massive amount of move-ins for the third quarter at Cobalt Row. All right, so now let's jump into kind of bad debt for the quarter. As you can see here, we actually are performing very well on this side. Closed out on the stabilized assets at 0.8% for the third quarter. We were at 0.3% in Q2. Recently acquired is higher at 2.2%. Again, assets that are acquired, first 6 to 12 months is going to be bumpy. This particular, move was likely driven from Palms at Edgewater. We went into that knowing that their tenant screening process was not very good and diligent from the seller side. There was a lot of unqualified tenants in there with leases expiring, and/or non-renewals that were going to be issued, or shaky credit and income. So kind of expected here, nothing alarming. We'll probably see that number on the recently acquired bounce around for the next few quarters until it starts to move over to the stabilized basket. New development side, really not an issue at this point, and feel pretty strong about that. So you could see here, on the bar graph, where the major moves were. They look a little more dramatic. Again, flats at Leland, legacy tenants there, Palms at Edgewater, pretty much exactly what I said in terms of the recently acquired assets that are driving the higher bad debt in the stabilized portfolio. Not surprising, those flats at Leland were evictions from legacy tenants that we inherited when we bought the deal, and then also similar with Palms at Edgewater. So nothing too surprising on that front. So as we start to look at our Q3 NOI growth trends, and this really ties into now, to kind of look back to where new trade outs were, renewals, we did see positive movement on overall average rents, but how does this all, and occupancy strength at 96%, how does that translate to NOI? So you could see here on the stabilized portfolio, we saw a 4.5% increase in NOI quarter over quarter. And on the recently acquired, we saw about a 4.2% increase quarter over quarter on NOI. Goal here is to see consistent incremental growth of NOI, quarter over quarter. Obviously, the new development side, meaningful. We're narrowing those losses as you have to feed new development until stabilization. 26% growth there on the ASH. But, really in this environment, very happy with the performance that we're achieving across the sites. We're moving into Q4, which is, going to be a challenge. Seasonality is real. We experienced it, last year. It's fully back in the market. Things and a lot of our efforts through Q2 and Q3 were to position ourselves to be in a better spot in Q4 and Q1 than we were last year. I think if you look back, our Q4, Q1 updates were rough. Portfolio level occupancies were in the, low 90s to upper, we had a handful of assets that were bouncing around the upper 80s. And a lot of that stemmed from us holding on to rents for too long, and battling the concession game, in a tough time of year, managing too many expirations through Q4 and Q1, which we really tried to make a mindful adjustment to this year, especially with the revenue management platform that we implemented, Rentana. Big part of that push was managing our lease expirations on a go forward, so we're not overly exposed. The teams did a heck of a job at URS Properties on looking to get ahead of our expirations. We started reaching out to our December, January, February expirations back in June to try to get ahead of it. Extend people for 3 months or 6 months, or offer them, a flat extension for a 6-month, so they would then expire in peak leasing season, pretty much between March and September. So, a lot of what we've done has been to position ourselves to be able to navigate some of the nuances of the near-term challenges on operations. So this again shows you where the NOI growth is coming from across the portfolio on an individual asset basis. Latitude at South Portland, really strong growth quarter over quarter. Farmhouse Apartments, great quarter. That was a big part of concession burning off, right? The property is now 95, 96% occupied, so concessions have burned off, the upfront concessions. Cobalt Row saw a drop. That has to do with turn season. It happens every Q3 because of all the turn expenses happen at one time for that property in the month of August. So it kind of suppresses NOI, and you'll see that start to tick back come next quarter. Everything else was pretty much consistent from a quarterly basis, with incremental growth and or, relatively flat. So one of the other things that we track on the stabilized assets is our trailing 12 year over year. So taking, assets that we've had for, more than a year to 2 years plus, and saying, okay, how are we tracking our trailing 12 months versus the prior 12 months on that same, same store, same asset. So if you look at the portfolio across the 1,600, plus units, we're up about 7%, 7.7%, 8% NOI growth year over year. So again, that's what our focus is driving NOI at this point. We know rent growth will come back. We know that demand is healthy. It's all a function of oversupply at this point that is being worked through the market. It's just natural economics. So we want to focus on, driving occupancy with quality residents, get incremental growth, be efficient with our expenses, look at ancillary income streams. You have to earn it today. It's no longer 21, 22, where somebody just renews a lease at 10% increases, because if they leave, they're going to get a 15% increase. It's more, you're battling up against somebody leaving to go get 2 months free at a new development somewhere. But once these deals get stabilized, and they will get stabilized, we expect to see normalcy, call it 2 to 4% rent growth, if not 5 in some of the markets that we're in, because the growth is still happening from a population and job perspective. So this, again, just consistently shows you on the individual asset level how the performance was year over year. Belmont Heights, really strong performance. Crescent Place, we had a pretty significant dip in NOI year over year. That's a function of, we came out, we did our renovation reposition plan. We hit our rents really high, really aggressive. We got to 95%. We got hit with massive insurance increases, tax increases, a lot of supply coming into Savannah. We had to start bringing rents down. We saw occupancy drop for 2 quarters in a row. That was one of those deals between Q4 and Q1. Was about 88% occupied. We had some bad debt challenges. And once we started to adjust our rents, we started to get occupancy back. We got bad debt under control. I expect to see that gap begin to shrink quarter over quarter as we move forward. You can see here also, farmhouse apartments, really a function of, concessions burning off. Cobalt Row, one of the best deals we bought during COVID. It was a student housing property in Murfreesboro, Tennessee, services MTSU. We're not traditionally student housing operators, but there was significant dislocation in student housing. It was November of 2020. Nobody thought that kids were ever going to go back to college. And we were building farmhouse apartments, getting ready to around the corner. So we had started to understand this market. Opportunity presented itself. There was no other bids. And we were able to get this at an extremely attractive basis. And it's been one of our top performers quarter over quarter. It's a fantastic asset. We've been averaging 6 to 8% year over year rent growth, and just executed a refinance, returned about 30% of the equity, and we have a double-digit, cash flowing asset there. So great asset. This is another new addition as we're going through trying to fine tune. CapEx invested for the quarter. We invested about a little over $2 million across our portfolio, some strategic upgrades to, one of the new assets that we bought, Palms at Edgewater in Somerville. We did a full overhaul on the amenities. It was a newer vintage product that we bought from the original developer, but they had massive delays. You can tell that, they didn't quite take the amenities to the level that they should for a Class A asset. So we were able to acquire the property at a really attractive basis and make some strategic investments. We did some outdoor decks, grilling, fire pits, all new pool furniture, some landscaping, some amenity enhancements of the club rooms, the co-working space, the gym. Really came out fantastic. Interior renovation programs right now are very delicate because rents aren't ripping. So you have to be really smart, really strategic, and monitor them very closely. We have a few of those going on across the portfolio. And then we have, we repainted at Cobalt Row. We did the first third of the property. So it's 250 units, but it's across single family, detached cottages and townhomes. So it's a 750 bed student housing property, but 250 units. But those units consist of basically 4-bedroom homes and townhomes. So we went through and we started a repainting program where we'll get through pretty much the entire property over the next 5 years. We did the first tranche there. So we do reinvest into our assets. We like to be capitalized appropriately on our deals to be able to do that. When we execute a refinance, we do hold back and kind of reset our 5-year CapEx plan. We are always willing to sacrifice a little bit of return in the near term for longevity over the long term, I guess, is how we look at it. We've been fortunate enough, knock on wood, to date, we've done, I believe we're up to 33, going to be 35 transactions. We sold 23. Not lost $1 of investor capital to date. I almost have a hard time even saying that out loud, but I think a lot of that stems from what I touched on earlier. We keep our leverage modest. We don't shoot for the moon in our underwriting. We bring probably more capital than most bring to a deal, but that allows us to preserve our assets, maintain occupancy levels, invest when we need to invest. What we're seeing in today's environment is, a lot of these groups that bought in 21, 22, or even refinanced in 21, 22 and levered up the heck out of it and distributed all this capital back to juice returns and didn't keep any cash in their back pocket. It's really a death spiral, right? When a property starts to get starved of capital and you can't keep up with turns or work orders, you start to take, a refrigerator out of a vacant to get this unit made ready or replace an occupied unit refrigerator. And then you don't have the cash to turn a unit, so therefore you can't rent it. You're not maintaining your exteriors, your curb appeal. You're not fixing things in a timely fashion. You're cutting staff. It really becomes a death spiral, and it's actually like the opposite in a challenging environment. You obviously can't spend frivolously because you're not going to get saved by the market, but you have to invest to be able to compete and attract the residents, to be able to muscle through and get to the other side of these kind of transitionary times when the market's in the process of going through a reset. So we take a lot of pride in that across our portfolio. All right, so another thing that we haven't historically shared is our investor distributions. So what you can see here again across the three different baskets, across our 7 properties that are stabilized, we have $113 million of equity as of the end of Q3. We did $1.8 million of cash distributions, and that's from operations. And that equates to 1.6% return on the equity for the quarter on those stabilized assets. Our recently acquired assets, it's 5 properties, $60 million of equity. We distributed $175,000, which is 0.3% on the equity. And in our recently acquired deals, we tell our investors typically within the first year, we don't like to rush distributions because we don't buy the most vanilla deals out there. Every deal that we buy needs some sort of reposition, whether it's operationally, CapEx investment, rebranding, something that needs to be done, which is why we see value in that opportunity. So typically in the first year, doesn't mean the property's not generating cash. We don't like to rush distributions till we get through that transition year and get the property to the other side. Obviously, new developments take time. We typically don't distribute on that. It's a sprint to a capital event. So build it, lease it, refinance it, and then start to distribute, return capital on refinance, and then distribute cash flow on a go forward. So the fact that, we're pretty much distributing across the portfolio of stabilized assets is, and we share this, and because I have these conversations with our existing investors when they come to me and say, should I do this deal? Should I wait for the next one? Should I put more in this one? Or our best investors to date that have been with us the longest, they like the space, they like us as operators, and they want consistent exposure. They do the same amount or minor variations in every deal that we do, and they build a portfolio around it because they know that some deals are going to be, cash flowing quicker than others. Some are going to be higher cash flowing. Some are going to be more upside. Some are going to be major repositions that we look to go in there and produce no cash flow, but then we either have a big exit or a big refinance in 3 years. So we like to share this with our investors because kind of shows you that if you're consistent and you're investing and building a portfolio, both getting geographic and asset diversity, this is what your returns would look like.
Something we're going to try to do each quarter is a property spotlight and just provide a little bit more detail on one of the assets in our portfolio that we're either focused on or that has hit a major milestone or something of that nature. So for this quarter, our property spotlight is Flats at Leland. Flats at Leland just hit its 1-year anniversary under URS ownership. It's been really a complete transformation. We acquired the property out of a distressed situation purchased it at the prior owner's debt basis or just barely north of their debt basis. And we closed all cash in under 30 days from contract to close. So, fairly quick timeline there. At acquisition, the property was in rough shape, right? Only 30% occupied, grass knee high, overall in need of major attention. Fast forward 1 year, and the property is now 98% occupied, fully stabilized. Since acquisition, we've executed a full repositioning plan, complete rebrand and landscape overhaul. We've renovated the leasing office. We renovated the fitness center. We've turned 103 units. We've signed 106 new leases within the first 12 months, which is a large majority of a 126 unit property. We rebuilt the on-site team with really strong leadership and consistent staffing, trying to set the foundation in Wilmington. This was our entrance into the Wilmington MSA. So, we now feel really good about our staff in Wilmington, and, we can leverage that as we continue to expand further across the Wilmington market. Going to the next slide here, the before and after photos help illustrate the progress we've made. When units sit vacant for extended periods, there are often additional maintenance and just turnover challenges that you incur. But we're very pleased with the current product. The units are clean, well finished and consistent to the standard we aim to deliver across our portfolio. Now, look, there's also an economic trend at play here. With the success of the lease up and the strong occupancy, it's no secret that rent and occupancy have an elastic relationship, right? As rents came down, occupancy responded quickly in the opposite direction. So we did have to lower rents here over the past 12 months, which is shown in this chart. We started at about, north of 1450 in the 1460s, and we hit a floor or a bottom in about July 2025 of 1342. This chart illustrates that pretty clearly. Each rent reduction brought a proportional lift in occupancy. All this happening while we're turning the property, while we're turning the clubhouse, while we're getting all new gym equipment, new landscape package, etc. So to prioritize lease up velocity and hit stabilization, we cut rents more than we originally planned, right? But that said, we do believe we've hit the rent floor. Again, that was in July, 1342 average rent. And since then, our average rent on the last 5 leases has been up significantly, back to 1466, which shows that, the trend is reversing and, our efforts are starting to be realized in the form of new rents and asking rents. So look, one of the key takeaways here is, distressed deals, especially in this challenging operating environment, they take time. Right? Rebuilding a property's reputation, reestablishing market confidence doesn't happen overnight, but we're very happy with the progress we made. And I do feel like we've really turned the corner. I'm really excited about the next 6 to 12 months here at Flats at Leland. We're going to continue to closely monitor the renewal strategies over the next 2 quarters, as we are planning to refinance the asset in 2026 once we've captured a larger volume of rent growth and operational stability. Right? Now that we're stabilized, now that we're 95% plus, we can start to play offense a little bit more, try to get more aggressive on renewals and push rents back to market, back to where we think ultimately they should be. So really excited to see how all this plays out over the next 6 to 12 months.